Trump's new write-off rules. High-income retirees must act now. Before diving into this topic, some ads may appear during the video. Your support allows this channel to keep sharing valuable retirement and investment insights for free. Let's dive in. Did you know that according to recent IRS data, the average high-income retiree could be overpaying the federal government by as much as 30% simply because they are operating on outdated tax assumptions? Most people in their 50s, 60s, and 70s are still following the rules of 5 years ago, unaware that the game has completely changed. If you have been diligent about your capital allocation and you have built a significant nest egg, you are currently standing in the crosshairs of a major tax shift. We are talking about a scenario where your required minimum distributions could collide with expiring provisions and new mandates, creating a perfect storm for your wealth. The reality is that the government is not going to send you a letter explaining how to save money. In fact, if you don't act before the next filing deadline, you might find yourself losing a massive chunk of your legacy to what I call the invisible retirement tax. We are currently witnessing one of the most significant overhauls in tax policy that we have seen in a generation, largely driven by the recent passage of the One Big Beautiful Bill. This legislation has fundamentally rewritten the rules for write-offs, specifically targeting high-income retirees and business owners. For years, we relied on the standard deduction and the SALT cap of $10,000 as our baseline. But now the landscape is unrecognizable. The IRS has just released updated inflation adjustments and new senior bonus deductions that could either be a windfall or a trap, depending on your modified adjusted gross income. If you are a business owner utilizing a pass-through entity, or if you are a retiree with a significant portfolio, the traditional methods of tax optimization are no longer enough. You have to understand that the new write-off rules are designed with very specific phase-outs. If your income crosses a certain threshold, even by a single dollar, you could lose thousands in potential deductions. This is why high-income retirees must act now. The window for proactive capital allocation is closing, and the cost of waiting is a direct hit to your net worth. Consider the case of a retired couple in Florida with a $4 million portfolio. For years, they structured their withdrawals to stay just under the next tax bracket, thinking they were being efficient. However, under the new rules, their failure to account for the adjusted phase-out of the senior bonus and the revamped Medicare surcharges meant they were effectively paying a marginal tax rate of nearly 45% on their last $50,000 of income. This isn't just a rounding error, it is a systematic erosion of their purchasing power. When we talk about liquidity management and wealth preservation, we aren't just looking at the stock market, we are looking at the friction caused by the IRS. Let's break this down into a framework you can actually use to protect your assets. The first principle you need to master is the new senior bonus deduction. Under the current legislation, if you are 65 or older, you are eligible for an additional deduction of up to $6,000 as a single filer or $12,000 for a married couple. Now, on the surface, that sounds great. But here is the catch that the general public often misses. The phase-out. This deduction begins to disappear once your modified adjusted gross income exceeds $75,000 for individuals or $150,000 for joint filers. For every dollar you earn above that threshold, the deduction is reduced by 6 cents. If you are a high-income retiree bringing in $250,000 or more, this bonus evaporates completely. This creates a massive incentive for strategic income timing. You need to look at your portfolio and ask yourself if you can shift income into different years to stay under those phase-out ceilings. This is a classic example of capital allocation where the return on investment is found in tax savings rather than market gains. The second principle involves the massive shift in the state and local tax deduction, or the SALT cap. For years, we were limited to a $10,000 deduction, which felt like a penalty for anyone living in high-tax states like California, New York, or Illinois. The new rules have temporarily raised this cap to $40,000 for joint filers. This is a game changer for wealth management. If you own high-value real estate or have significant state income tax, you finally have a way to write off a much larger portion of those expenses. However, this is not a permanent fixture. It is a scheduled expansion that will eventually revert, making it a critical use it or lose it opportunity for your current tax planning. You should be looking at your property tax payments and state estimated taxes to ensure you are maximizing this $40,000 window while it exists. The third step is perhaps the most important for business owners and high net worth investors: the permanent status of the Section 199A deduction. This allows qualifying business owners of pass-through entities to deduct up to 20% of their qualified business income. While this was originally scheduled to sunset, the new laws have made it permanent while also adjusting the phase-in limits. For the current year, those thresholds have moved to $150,000 for single filers and $300,000 for joint filers. If you are an investor with interests in LLCs or S corporations, this is your primary tool for lowering your effective tax rate. By combining the 199A deduction with the expanded SALT cap and the senior bonus, a sophisticated taxpayer can significantly lower their taxable income, often dropping themselves into a lower tax bracket entirely. This isn't just tax preparation. This is institutional-level asset-based lending and business structuring. The fourth principle focuses on capital allocation and the strategic use of Roth IRA conversions. With the current tax brackets being locked in as relatively stable, we have a level of certainty that we haven't had in years. This is the time to evaluate a multi-year Roth conversion strategy. Why wait for required minimum distributions to push you into a 37% bracket when you can pay the tax now at a lower rate? Think of it as buying your future tax freedom at a discount. If you have a large traditional 401k or IRA, you are essentially sitting on a debt to the IRS. By converting portions of that to a Roth now, you are using today's write-off rules to eliminate a massive future liability. This is especially vital for estate planning, as a Roth IRA is a far more efficient vehicle for your heirs than a traditional tax-deferred account. Beyond the immediate tax forms, we have to look at how these rules affect your Medicare premiums. This is the part of the conversation where many retirees get blindsided. The IRMAA, or Income-Related Monthly Adjustment Amount, is a surcharge on your Medicare Part B and Part D premiums if your income exceeds certain levels. The new write-off rules can actually help you stay below these IRMAA cliffs. For example, if by utilizing the expanded SALT cap and the 199A deduction, you can keep your income under $206,000 as a couple, you could save over $4,000 a year in Medicare surcharges alone. This is a hidden return on your tax planning that doesn't show up on a 1040, but certainly shows up in your bank account. The global perspective also adds a layer of complexity. If you have assets in the United Kingdom, Canada, or Singapore, the way the U.S. treats foreign tax credits has also been adjusted in this new bill. For the high-income retiree with a global footprint, ensuring your international capital allocation doesn't trigger double taxation is more difficult than ever. The US-centric foundation of these rules means that while the write-offs are generous for domestic assets, they can be restrictive for foreign holdings. This is why a unified approach to your portfolio is necessary. Now, how do you actually implement this? Your first action step is to conduct a comprehensive income audit. You need to sit down with your latest statements and project your modified adjusted gross income for the current year. Are you hovering near those phase-out thresholds for the senior bonus? If so, look at your capital gains. Can you harvest some losses to bring your income down? The second step is to review your itemized deductions versus the standard deduction. With the SALT cap now at $40,000 and the standard deduction for married couples rising, the math has shifted. Many people who stopped itemizing years ago will find that it is now significantly more beneficial to itemize again. Third, if you own a business, you must verify your eligibility for the permanent 199A deduction. This might require restructuring how you take your draws or salary to ensure you are maximizing that 20% write-off. Finally, you should establish a tax loss harvesting protocol for your brokerage accounts. In a volatile market, these paper losses are actually valuable assets that can offset your gains and keep you within the optimal tax brackets. To summarize what we have covered, the new tax landscape offers incredible opportunities for those who are proactive, but presents major risks for those who remain passive. We have looked at the new $12,000 senior bonus for couples and why you must stay under the phase-out limits to claim it. We explored the expanded $40,000 SALT cap and how it rewards those in high-tax states. We discussed the permanent nature of the 199A deduction for business owners and the vital importance of Roth conversions in a stable tax environment. The key takeaway is that wealth is not just about what you earn, it is about what you keep. By aligning your capital allocation with these new write-off rules, you are essentially giving yourself a significant raise without having to work a single extra hour. If you found this breakdown valuable and you want to stay ahead of the curve as fresh videos on this subject are uploaded regularly, please click the thumbs up button to give us a like as a thank you for this valuable content. It helps the algorithm share this information with other investors and business owners who need it. If you have questions about how these phase-outs might affect your specific portfolio, or if you have a strategy that has worked for you, please comment sharing an idea from the video content, or any questions or concerns you have. I read through the comments and love seeing how you are all navigating these changes. And of course, make sure to subscribe to the channel so as not to miss our next deep dive into the strategies that the institutional world uses to stay wealthy. I am not your financial advisor. The information provided in this video is for educational and illustrative purposes only and does not constitute investment, legal, or tax advice. Every financial situation is unique, and tax laws are subject to change and individual interpretation. You should always seek professional advice from a qualified fiduciary, CPA, or tax attorney before making any significant financial decisions or implementing the strategies discussed today.